Hello there, I'm Aaron Johnson with the Dwayne Johnson Group and Bridger Financial Services. Hard to believe that we're halfway through 2024 already. It just seems like yesterday we were closing out 2023. But time marches on, so let's go over the first half of the year and discuss how things are shaping up for the second half of the year. So far, 24 has been a pretty good for the market, pretty good year for the markets. We continue the momentum from the lows of October 2023 and have notched record highs along the way. The first half of 24 has been a lot better than the first half of last year when we were dealing with the mini banking crisis, higher inflation, and recessionary fears. This time around, we had nearly two identical quarters featuring a dip or two, and then a rebound featuring new highs. The first dip was when the market came to grips with the fact that they were not going to get 6 or 7 rate cuts as was expected going into 2024. After setting records at the end of March, we had a mild pullback when the Fed said it was more realistic to expect 2 or 3 rate cuts, and then the markets readjusted. The second, even milder dip occurred when we saw that the first quarter gross domestic product, or GDP, came in at a plus 1.3%, far below the prior quarter's 3.2% growth rate and well below expectations of 2.5%. Now, we are told to expect 1 rate cut after the elections in November or December. Inflation has hovered above 3% for a year now, and with the economy slowing, the Fed is going to have to make a choice pretty soon. Does it keep rates at these higher levels and risk recession to tame inflation by 1%? We'll talk about that when I cover outlook for the second half coming up here in a few minutes. There hasn't been much to complain about in the first half of the year. The S&P 500 is over 5,400 points and had touched 5,500 at one point after starting the year at 4,770. NASDAQ surpassed 17,000 from up just over 15,000 at the end of 2023. Meanwhile, the yield on the 10-year Treasury is over 4%, and at one point in the first half of the year was approaching 5%. There were plenty of places to generate returns, and despite all the hand-wringing and gnashing of teeth, it wasn't that uncomfortable as we made our way into double-digit equity returns. The yield curve has been inverted for nearly 2 years, which is a record. Plus, we've had higher inflation for 2 years, and interest rates are high, yet there's not been a recession, and markets are managing just fine, even though we all wish participation was a little broader. In my assessment, given the imperfect nature of things, there was plenty to worry about in the first half of the year, but none of our worst fears were realized. If you stood your ground, were patient, and followed your plan, you were probably rewarded. We had a pretty good first half, as good as any I've seen in recent memory, but we all know halfway is not all the way. Does anyone remember 2018? We will have to contend with the second half of 2024, and that may not be as comfortable as the first half of this year. So how will the second half play out? Well, it's always hard to make predictions. Given everything that's in motion right now, there are some likely catalysts that could move the markets from the upcoming elections to what the Fed does with rates in the face of a slowing economy, or just inflationary pressures, not to mention the possibility of some geopolitical event that could send a shock through the markets. The good news from my standpoint is that there are a lot of things that can go right, and I'm happy to provide an intelligent and informed outlook based on what we're seeing. So let me start with where I stand. I'm optimistic we'll have a strong second half, but end that sentence with a full stop, right? But that optimism will be tested. First off, there will certainly be more volatility in the second half of 2024, This year has been remarkably tame from a volatility standpoint so far, and the calm for the first half points to a rocky second half. Then we have the Fed. So far, it has managed to keep rates higher than anyone expected. If things play out the way they are right now, and we continue to see economic weakening, I would not be surprised to see a rate cut prior to November or December, as the Fed has announced most recently. If that happens, it will likely supercharge equities, which have been eagerly awaiting the beginning of a rate cut cycle since the Fed paused rates last July. Then there's also the upcoming election, which will bring pressure from the Fed, from incumbents seeking re-election to lower rates and improve the economy. Whatever the catalyst, I believe the Fed will cut rates in September and surprise everyone, especially the equity market. The other wild card out there is the potential for something on the international front, whether it is an escalation in the conflict in the Middle East, significant change in the Russia and Ukraine war, or possibly some shenanigans with China and Taiwan. That could significantly change the dynamic for the world economies and energy prices. If any of those things occur, all bets are off. We'll be back in 3 months and we'll catch up and see how things are going. Until then, follow your plan, talk to your advisor, and be patient. The market has been really good in the first half, but I would not urge complacency. I would focus on what can be controlled, specifically your emotions, your plan, and how that plan will help you stay on track to meet your goals. If you're out of balance with your portfolio, please consider rebalancing back to your base case. Now's not the time to lose focus. Think big picture and push out all the external daily events, which will drive you crazy if you keep chasing the latest news headlines. If you have any questions, please give us a phone call. Thank you and have a great day.